Hi everyone, welcome back to Wise Wealth. I'm Kazu, and I'm here to help you live a life that's not tied down by money. Whether you're staying in a job just because it pays well or giving up on your dreams because of financial limitations. Through this channel, we're learning how to achieve financial freedom by understanding the principles of accounting and making smart financial decisions. In our last video, we talked about the importance of avoiding high-risk, speculative investments and focusing on steady growth through reliable options like S&P 500 index funds. Today, we're going to dive into the next step: how to build a diversified portfolio that helps you grow your wealth while managing risk. What is a diversified portfolio? A diversified portfolio is simply a collection of different investments that balance each other out. Instead of putting all your money into one type of asset, like stocks or real estate, you spread it across various asset classes. This helps reduce risk because if one investment underperforms, others can still provide growth or income. Think of it as not putting all your eggs in one basket. Why diversification is important? Diversification is key to building long-term wealth. Every type of investment comes with its own risks. Stocks can be volatile, real estate values can fluctuate, and even bonds can be affected by interest rates. However, when you diversify across different types of investments, you spread out your risk. That way, if one area of your portfolio is performing poorly, other areas may still be growing, protecting your overall wealth. It's the same principle big companies use. They don't invest all their money into one product or service. They diversify their offerings to capture a broader market and reduce the impact of any single product's failure. You can apply the same logic to your personal investments. What to include in your portfolio? Let's talk about the different types of assets you should consider to build a diversified portfolio. Stocks, equities. Stocks are an essential part of any portfolio because they offer the potential for higher returns over time. You can invest in individual companies or, as we discussed in the last video, broad market index funds like the S&P 500. These give you exposure to many different companies at once, making it a safer bet than putting all your money into one stock. Bonds. Bonds are a more stable investment compared to stocks. When you buy a bond, you're essentially lending money to a company or government in exchange for regular interest payments. Bonds provide a steady income stream, and while their returns are generally lower than stocks, they offer stability, which balances the riskier parts of your portfolio. Real estate. Real estate can be another excellent way to diversify. It provides a tangible asset that typically appreciates over time and can generate passive income through rental properties. Real estate is less volatile than the stock market, and it can serve as a hedge against inflation. Cash and cash equivalents. Always keep a portion of your portfolio in cash or liquid assets, like money market funds. This ensures that you have quick access to funds for emergencies or for taking advantage of new investment opportunities. It also adds another layer of stability to your overall portfolio. Other investments. Depending on your risk tolerance and financial goals, you may also want to explore other types of investments like commodities, gold, silver, mutual funds, or even small business investments. Just be sure to understand the risks associated with each before diving in. Balancing risk and reward. The key to building a diversified portfolio is understanding your risk tolerance. How comfortable are you with fluctuations in your investments? If you're younger, you may be able to take on more risk because you have time to recover from any losses. If you're nearing retirement, you may want to focus more on preserving capital and reducing exposure to volatile investments like stocks. A good rule of thumb is to allocate your investments based on your financial goals and where you are in your life. For example, younger investors may have a portfolio that is more heavily weighted towards stocks, while older investors may prefer a higher percentage of bonds and other stable income-generating assets. The importance of regularly rebalancing. Even if you create the perfect diversified portfolio today, it won't stay perfect forever. Over time, certain investments will grow faster than others, shifting the balance of your portfolio. This is why it's essential to rebalance your portfolio regularly. Rebalancing means adjusting your investments to ensure they're still aligned with your long-term goals and risk tolerance. For example, if your stocks grow rapidly, You may find that they now make up a larger portion of your portfolio than you're comfortable with. In that case, you'd want to sell some stocks and reinvest that money into bonds or other assets to restore balance. Your next steps. Take a look at your current investments. Are they diversified enough to weather the ups and downs of the market? If not, it's time to make some adjustments. Building a diversified portfolio takes time, but it's one of the most effective ways to protect your wealth and ensure steady growth over the long term. In our next video, we'll dive into how to assess your risk tolerance and create a personalized investment strategy that fits your financial goals. Let's continue building our financial knowledge and working towards wise wealth together.